Hi everyone, it's Sean back with another video. Today I'm going to talk about Johnson & Johnson. Fabulous company. It's been a slow growth over the last 5 years, losing to S&P. Obviously absolutely smashing it over the long term, primarily due to less than stellar growth and some legal issues. This is of course without the dividend payments, which are not insignificant. Johnson & Johnson is a dividend king. Stock is only 5% removed from its yearly highs, despite a wider market decline, clearly seen as a safe company to hold. I want to figure out is after a slow couple of years, is Johnson & Johnson now undervalued, or is there still some room for the stock to drop before it's attractive pricing? The big news that came out not that long ago, and the biggest news from Johnson & Johnson in a long time, is that the company is spinning off its consumer health segment. Stock spin-offs have traditionally been quite successful in unlocking shareholder value in the past. Think Pfizer and Upjohn, which became Viatris, eBay and PayPal more successfully, and even more successfully probably AbbVie and Abbott Labs. Separating the businesses will, in theory, allow for greater focus within each business, offer benefits, J&J based, so more opportunities for J&J employees, hopefully creating a better culture in each of the individual businesses, and hopefully better value for patients and consumers. Consumer health business did 14 billion revenue this year, and pharma did 52 billion in revenue. So there's both absolutely excellent businesses, and I'm sure both will continue to be excellent businesses standalone, and I would be happy to own both of them. Just to give an illustration of how wide the current band portfolio is, you look at that, this is making Johnson & Johnson essentially an ETF. So many, large business units with so many brands. Business units are split into consumer health, pharma and medical devices roughly, but there's also the skincare segment, consumer goods and vision. An insane number of huge brands here, present in every home in America, sure, many around the world. Tylenol, Benadryl, Listerine, Compeed, Band-Aid, Pepcid, Sudafed. These are just for the consumer health business. There's obviously a ton of others. Rogaine, Neutrogena, Aveeno in the skincare business. Ton of value to be had here in splitting these up. Both consumer health, medical devices and pharma are all absolute giants in their industry. As I mentioned, pharma alone is a $52 billion revenue last year. Serious brand power here. Looking at consumer health in particular, some seriously really strong brands. Just looking at the most recent full year sales, really quite a strong year for Johnson & Johnson. Obviously the bonus of the COVID vaccine being added in. They reported 9.3% sales growth in the US, up to $47.2 billion. In Europe, 23.6, up from 19 billion. Everywhere, growth up everywhere. West Hemisphere was only up slightly, excluding the US. International growth, again, absolutely excellent. Reported 18.2% change. Worldwide, that gave a total of 13.6% reported and 12.2% operational growth. Both absolutely excellent. Very good for a business this size, scale, and maturity. They're expecting around 7% growth next year. A bit of a return to form, essentially. This is an abnormal year where they've done absolutely fantastic. The key thing that many people want to hear about when talking about Johnson & Johnson is the dividend and the capital allocation. Johnson & Johnson is a dividend king, as many know, as it increases dividend payments every year for the last 59 years. The dividend today is 2.5%. The most recent payment was $4.19 a share. This has doubled since 2009, illustrating the incredible dividend growth on offer here, even at just 6 or 7% a year. Returning capital to shareholders is foundational to Johnson & Johnson and is something the shareholders have become accustomed to and is seemingly a priority for management. Dividend payout ratio is 61%, which is completely reasonable in my opinion. About $11 billion in dividends paid to shareholders last year on $20 billion in cash flow. They plan to continue share buybacks when reasonable and invest in R&D and mergers and acquisitions to maintain growth. R&D investment in the full year of 2021 was a massive $14.7 billion, showing a clear commitment to organic growth. It's $14.7 billion. Admittedly, this is a $460 billion company, but revenue-wise, $93 billion in sales and 14.7 invested in R&D. Absolutely fantastic numbers, showing a clear commitment to the organic growth and the future of this company. Taking a look at some business fundamentals. First, the balance sheet. Balance sheet is pretty good here. Cash debt ratio of 0.94 is pretty good for the industry. Not the best. I would like this to be less debt, but about $34 billion in debt and $32 billion in cash on the balance sheet. I'm completely fine with this. On a market cap of $446 billion, $34 billion in debt is absolutely fine by me. Debt to EBITDA is solid at 1.11 and interest coverage is excellent. The company has been assigned an Altman score of 4.46, indicating that the company is not at risk of immediate financial default, which makes sense considering the strong coverage here. As it stands today, Johnson & Johnson has a AAA credit rating given by S&P. a better credit rating than the US government right now, and the only other company to share this rating is Microsoft. A truly prestigious award. It shows the strength of Johnson & Johnson's balance sheet and its reliability as a business. These essentially its profits are as safe as houses. Operating margin 26%, absolutely superb for this industry. Very strong for the company's historical valuations. Net margin of 22.25% is also outstanding for this industry and well optimized for Johnson & Johnson's history. Return on equity, again, absolutely outstanding. Can't emphasize this enough. This is an exceptional number for a company of this scale and maturity. Return on equity percentage of 30%. Return on assets, not as impressive, but pretty impressive at nearly 12%, where I'd expect between 5 and 10 for a company like this. These metrics are all absolutely fantastic, demonstrating the pricing power and strength Johnson & Johnson has in its industry, as well as the excellent execution of the management team. This is a very financially secure company, and with excellent margins, this is a really well-positioned company moving forward. Taking a look at some basic valuation metrics. Judging by these basic valuation metrics, the stock is absolutely not in bargain territory. PE ratio of just shy of 22 and forward PE of 16. Trailing price earnings is about slightly below the S&P 500 average of 24. Johnson & Johnson typically trades at a premium to the index due to its dividend history and historical returns. This is indicated by the versus history column. These are some of the lowest earnings multiples seen for Johnson & Johnson in a very long time, particularly relative to the index. Price earnings is not the only one I'm interested in, although it is the priority. Price free cash flow is again not conventionally cheap at just under 23 times. PEG ratio of 5.57 is far above what I would consider reasonable. Under 1 is bargain, 1 to 2 is kind of fair value, 5.57 is pretty expensive, but is very strong for the company's history. As I said, this is a company that typically trades a significant premium to the S&P due to its perceived quality, and this PEG ratio has came down significantly in recent years. The final thing I'm going to do is do a discounted cash flow calculation to work out the fair value of the business based on the sum of its future cash flows discounted to the present. I'm going to use the 10-year average free cash flow growth rate of 6.6%, which I think is achievable, if perhaps a little conservative going forward. I'm going to use an 8% discount rate for the long-term returns of the stock market, and you're doing both of these. This gave a fair value of $121, indicating that the stock price today is a significant premium over fair value. To achieve fair value by this calculation, free cash flow growth will need to average over the next 10 years around 11%. I do not think this is achievable. I'm not completely sold on this. But I say it's not achievable. I think it's definitely possible, but I'm not sold on Johnson & Johnson's ability to do this, given that over the last 10 years they've averaged 6.6%. Over the last 5 years they've averaged 5.8%. I'm not really seeing any reason to do this. Perhaps the pharma business can do this. That's grown at 14% revenue year over year. The consumer health business, as it stands, is growing 4% a year. So I think they're definitely being weighed down by this at the minute. Perhaps the pharma company in the future will have a more reasonable DCF and a more reasonable valuation in line with their industry. So to summarise, I'm definitely a fan of this business. As I mentioned, historically, stock spin-offs have created strong value for shareholders in a lot of instances, particularly PayPal and eBay and AbbVie and Abbott. Whether this one will is unknown. Certainly the pharma business is the larger and more attractive of the two, in my opinion. It's definitely the one I'd be more interested in. Pharma business grew 14% compared to 4% for the consumer health. Also has more attractive margins. Of course, I like the business and I like its prospects moving forward. I think it's definitely a critical company for many people. All its incredible brand power has such a serious moat based on these brand powers. I think it's critical when buying a mature company to pay a fair price. Johnson & Johnson rarely trades below the S&P 500 index due to perceived quality and sought after dividend for income. From my likely conservative calculation, Johnson & Johnson is trading significantly below its calculated fair value, so I would like to see the stock drop a little bit before I'm buying a large amount. I regret not pulling the trigger early in the year when it was at more sensible prices, and I'll have to live with that mistake. If Johnson & Johnson hits the 120 to 130 range again, I'll be loading up for sure. I'm not absolutely tethered to the fact that it has to hit my fair value expectations, but I want to pay a more reasonable price than the $170 it is today. I think that's a bit much. I'd like to get the dividend yield around 3% before I was pulling the trigger. With that being said, no, this is financial advice. It's just my opinion. So if you want financial advice, speak to a registered financial advisor, and of course do your own research and due diligence. Like the video if you're enjoying the content and want to help the channel grow. I'll see you next time.